Um, Happy Wednesday. Happy August 14th. Looking forward to a great remainder of the week. I hope you are too. And let's get started on our weekly webinar. So today we're going to follow our normal format. We're going to have some updates from the Slott Group, and we're going to go over some market activity, some headlines, and then we're going to have our financial focus. Now, our financial focus part of the webinar today is going to talk about, is life insurance right for your retirement plan? Life insurance can be complex. There are many different opinions out there about the use of life insurance in retirement plans. I'm going to share some concepts and tax facts and discuss pros and cons in that financial focus section. But first, let's start. I want to share my goals with you as listeners to this webinar, to this YouTube channel, to these now podcasts. You can find us on any service that offers podcasts. The name of the podcast is Not a Guru. That was chosen, it was inspired by my friend David McKnight, who just released his latest book about those financial gurus out there, Dave Ramsey, Susie Orman. So you can buy that book now on pre-order in Amazon. I suggest you go get it. But I've shared with you that I'm concerned about the advice given on YouTube channels, on podcasts. So this channel is not designed for advice. Advice should be individual. You should work with your financial planner. If we're fortunate enough to work with you, we work one-on-one with you. Our team really digs in and we work with you. But use these channels, this channel for sure, as education, things to inspire you to make changes. So I want you to be inspired to make changes. I want you to open your mind to different ideas and different ways of thinking and planning and investing. I want you to stay educated. First, be educated. Learn what you don't know already. These critical items I always talk about. These things that maybe if you knew these things, you would have done things differently in the past. But now you know these critical items. Tax planning, cash flow management, proper investment structure, things like that. Just to name a few. But some of these critical items, if you would have done things or known them earlier, you would have done things differently, but you're learning them now, or you know them now, or you have the right resources now, and you can make changes now. No one has ever sat across the table from me or across the camera from me and said, gee, I wish I would have waited to do this another 5 years or 10 years. Everybody, I'm pounding the table. I don't know if you can hear me. Everybody says, oh, geez, I wish I would have done this sooner. So you have the opportunity to do that. Stay educated so you feel confident in the plan and strategies that are put in place. Watch these videos, listen to the podcasts so that you're updated and you can make adjustments along the way. So we bring this to you nearly every week. We've got another one coming next week. I'm on vacation the following week, so I won't see you that week. But we bring you, I hope, good information almost every week. So let's talk about headlines, and good morning, Doug. So yesterday we got the producer price index number. So I'm looking at the BLS, Bureau of Labor Statistics report. So these hit my email inbox. You can get them as well. You go to BLS and sign up for it if you really want that. But the PPI, Producer Price Index for Final Demand, rises. This is the headline from the BLS, Bureau of Labor Statistics. So the PPL for final demand rises 0.1% in July. Goods increase 0.6%. Services decline 0.2%. So what does that mean? That means for the 12-month period combined, in the producer price index inflation was up 2.2%. So good news, and we were waiting for CPI this morning, which of course already hit. It's 10 o'clock. But I've got that headline also for you. So as of this morning, the Bureau of Labor Statistics released this report, and they said CPI, Consumer Price Index, for all items rises 0.2% in July. So they go on to write, in July, the Consumer Price Index for all urban consumers rose 0.2% seasonally adjusted and rose 2.9% over the last 12 months, not seasonally adjusted. The index for all items less food and energy increased 0.2% in July, up 3.2% over the year. So these are all good numbers, especially the adjusted Consumer Price Index for all urban consumers down or at, not down, but at 2.9%, which of course is lower than what we've seen certainly since the pandemic. So that's all good news, and it's still inspiring to see what the Fed's going to do in September. So I'm just looking at my stock screen right now, and it was interesting because that's good news, right? That the consumer price index inflation is not going down. So things are still expensive, but the increase is slowing, and that's what the Fed is. What's one of the key elements that the Fed is looking for. But we're seeing initially we saw the futures, which tells us what we think the markets are going to open at. That was in the red, right? That was showing a negative market open, but that's not what we're seeing right now. Well, the Nasdaq's down a bit, but it looks like the S&P 500 was up, and the Dow Jones might have been down, or vice versa. But so we've got kind of a mixed bag going on right now. But they're the headlines. So now let's talk about, or I'm going to share some articles from the Slott Group. So let me share with you this article that came out obviously Monday, August 12th. So hot off the presses for you folks. And the title is Proposed Regs Bring New Rules for Spouse Beneficiaries When Death is Before Their RBD, which means Required Beginning Date. This is by our friend Sarah Brenner at the Slott Group. Sarah writes, and if you're just listening on the podcast, let me pause for a second. If you're just listening on the podcast, what I'm doing now is I'm sharing my screen with this very important information from the Slott Group. Our friend Kathy had recommended before that hi Kathy, that we share, that I share this screen so people can read along. I think it's an excellent recommendation, so I've continued to do that probably close to, 2, 3, 4 years now. So Sarah writes, so if you are just listening, I promise you I'll get there. If you are just listening to the podcast, you can go to the YouTube channel and read along with me because I am sharing this on the screen. Of all the many provisions in the Secure 2.0 Act, none has been more perplexing than Section 327, which changed the rules for spouse beneficiaries. It has been hard to figure out what Congress intended in drafting Section 327. The legislative history is scant. On July 18th, the IRS issued proposed regulations on the Required Minimum Distribution, or RMD, rules from Section 2.0 Act. One significant part of these proposed regulations is the IRS's interpretation of Section 327. The Senate Finance Committee report, which explains the provision of Section 2.0, said only the following. Section 327 allows a surviving spouse to elect to be treated as a deceased employee for purposes of the required minimum distribution rules. But what exactly does allowing the surviving spouse to be treated as the deceased spouse mean? The statute is not clear, but in the newly released proposed regulations, the IRS explains the rules. Now, let me say, I'm going to just pause for a second. These are proposed regulations. So these proposed regulations can become final regulations relatively soon. It could last a significant amount of time. We could have revisions, and there will be typically there are answers to questions regarding the proposed rules, and that's where you see changes to the final regulation. So going on to write, under the proposed regulations, a surviving spouse can delay RMDs until the IRA owner would have reached the age when RMDs must start, currently age 73. When death is before the required beginning date, or RBD, currently April 1st of the year after a person reaches age 73 for most, this happens automatically. When RMDs start on this inherited IRA, the surviving spouse beneficiary will calculate RMDs using their age in the Uniform Lifetime Table. The use of the Uniform Lifetime Table to calculate spousal beneficiary RMDs is new and will result in smaller RMDs. There's a completely different table. There's the single life expectancy table that was used with inherited IRAs. Now for this, and just in this case for surviving spouses, they've changed it to the Uniform Lifetime Table. This table had only previously been used to calculate RMDs during an individual's lifetime. Now it's also being used to calculate it for an inherited IRA distributions. Required minimum distributions. The new regulations also make it clear that when 327 applies, the IRA is still considered an inherited account. This means that the 10% early distribution penalty does not apply, which is good news for young spouse beneficiaries who may need the money. Also, in more good news, despite the automatic inherited IRA creation, the regulations clarify that a spousal rollover can still be done at any point. Example, Derek dies in 2024 at age 50. His beneficiary is his spouse, Katie, who is age 54. Katie will not have to take RMDs on the automatically created inherited IRA until Derek would have been required to start taking them. This will allow her to delay RMDs for decades. When she starts taking RMDs, she will use her age and the uniform lifetime table. Katie can take distributions at any time from the inherited account. These distributions will always be penalty-free regardless of her age. She can do a spousal rollover to her own IRA at any time. So I haven't had a chance to discuss this new regulation with, or proposed regulation with our office manager, Jessica Fee, but I can just envision her smacking her forehead saying, geez, they're making these she's responsible for RMDs in on our team. And I know she's just saying they're making these RMDs more challenging every single year. Now think about it. When they make changes to RMD rules, we use these online calculators. Well, now how long is it going to take for the online calculators to catch up when we're calculating these RMDs? It's this came out at the end of July, I guess it was, or early August. And how long is that going to take for these online calculators to catch up? So now if someone's in this position, we have to do manual calculations. So sorry, Jess, but it continues to be more difficult. And that's why you have to have your retirement team together and knowledgeable people on these retirement teams. I'm going to talk during the Financial Focus about some material from the Slott Group, and I'm going to share just a couple things with you. But you see it, you folks who are with me every week or are listening. And I have to say, our subscribers have increased tenfold since the beginning of the year, tenfold. So I want to thank everybody for following the channel, and I guess you're getting some good stuff out of it. So that's good. So the next is from Ian Berger, and this discusses inherited Roth IRAs and NUA, net unrealized appreciation. So the question is, thank you for all the wonderful information. I have a question as to how the July 18th, 2024 final regulations, these are final regulations, impact inherited Roth IRAs. My daughter inherited Roths from their grandmother 3 years ago. She was age 101. They were planning to just let them grow until the end of the 10-year payout period. Do the new Final Secure Act regulations now require them to take RMDs before 10 years? Again, these are Roth IRAs. Similarly, assuming no law changes based on the July 2024 regulations, if they inherited my Roth IRAs, I am now 74, will they need to take annual RMDs or just do a payout by the end of the 10 years? My understanding is that in both cases, they would not be an eligible designated beneficiary. Really, really great question. And the answer is easy in this one because they're Roth IRAs. But I'm not going to jump in. Let's let Sarah answer the question. The answer is you are correct that in both cases, your daughters are non-eligible designated beneficiaries, or referred to as EDBs. That is why they were subject to the 10-year payout rule. But since they're inheriting Roth IRAs, they are not required to take annual RMDs during a 10-year period and can let the inherited Roth IRAs grow tax-free for 10 years. The recent IRS regulations did not change this rule. That is because there is no required beginning date for a Roth IRA. A Roth IRA owner is never required to take a required minimum distribution. So that passes on to their heirs. So there is technically one required minimum distribution, and then that is the one in the 10th year following the year that person inherits the Roth IRA, and this is only for Roth IRAs, but there is no requirement like there are for some IRA beneficiary IRAs to take required minimum distributions along the way for Roth IRAs. So I hope that's helpful. The next question is, I attended the recent Instant IRA Success 2-day IRA workshop in Maryland, and I have a question on net unrealized appreciation opportunity for a client who is age 62 but still working at his employer. He would like to complete the in-service withdrawal with NUA, but would still be contributing to his 401k for the remainder of the year and until retirement. The subsequent contributions will cause the account to not be at zero as of 12/31/2024. Can he use the NUA strategy now? So let me share with you, and I'll link this again. I think it was linked in last week's video, but we'll link it again since we're talking about NUA. We have a video that I did with Andy Ives from the Slott Group discussing NUA, or net unrealized appreciation. Net unrealized appreciation allows you to move company stock that you have in your 401k and distribute it directly to a non-IRA investment account, and you only pay ordinary income tax, that tax that's like you earned it, and is typically higher for most people, on the amount that you invested in the company stock. So what we refer to as the basis. Any growth, and then if you decide to sell that stock, any growth is taxed as capital gains, and you don't have to wait. It's long-term capital gains. You don't have to wait a year like you do with a stock position or any other non-IRA investment position. You can sell it right away and still have that potential long-term capital gain treatment, right? Or it would be long-term capital gain treatment. The potential is if it's better than your ordinary income tax rate. So it can be a really good strategy for somebody who has a large amount of, or any amount of company stock in their 401k or a retirement plan, and didn't pay or paid significantly less for that company stock than what it's valued at today. So it can save thousands or sometimes hundreds of thousands of dollars in tax. So an NUA strategy can work well. But there are very clear requirements, and you can easily violate these requirements. So the answer to this question about NUA, Ian writes, thank you for attending our workshop. For your client to use the NUA strategy now, he would have to empty his entire 401k account by 12/31/2024. It's got to be emptied. The entire thing has to be emptied by the end of the year, and stop contributing for future years. If he were to continue to contribute, he would nullify the NUA distribution. He could also wait and use NUA in the calendar year when he separates from service, or in any subsequent calendar year, but he would have to take his entire 401k out during the calendar year that he completes an NUA transaction. So that is a requirement. So in this case, that doesn't work because that person's just trying to move out the NUA. Now, if he flipped it, if he said, okay, let's just use $2 million. If I have $1 million that's not in company stock, and I have $1 million in company stock, and I wanted to keep my company stock in my 401k, but I wanted to roll over the $1 million into an IRA, that would not violate the NUA rules. So you could do that, still contribute to the plan, not violate the NUA rules, roll over the company, the non-company stock to an outside IRA, and not violate the NUA rules. Good. So that's the Slott Report. Let's talk a bit about the markets. So I'm first going to talk about what happened in the markets last week. So the S&P 500 was down 0.02, still up 12.96% for the year. The NASDAQ was down 0.17%, still up 12.01%, but boy, has that lost a lot of ground. Around the world, the MSCI World Index, that's the large companies, not including U.S., the United States, was down 0.08. Year-to-date is 4.49. Emerging markets was positive, 0.28%, at 6.01% for the year. Europe, Asia, and the Far East was down 0.28%. That's interesting. Emerging markets are up 0.28%. Europe, Asia, and the Far East was down 0.28%. It's purely coincidental. But that index is up 4.51%. The bond index was down 0.82%. So this is another example where the stock index was down, the bond index was down. Year to date, we're only at 2.3% for the U.S. aggregate bond index, and that's where most people have their bond holdings. The Fed funds target remains even across the board now in this report I have in front of me. So it was at 5.5%. The close of business on August 9th, it was at 5.5%. The close of business August 2nd, it was at 5.5% at the close of business on 12/29/2023. And 1 year ago, it was at 5.5%. Okay. Now, what do our analysts say about some of the goings on? Last week, what did we see as far as reports, and what's the impact of these reports? So last week we saw ISM Services. This survey that covers the broader section of the economy posted a reading of 51.4, while the new order index came in at 52.4, both above the 50 mark that separates contraction from expansion. So important readings. You may not, I know you may not understand what they mean, those numbers, but it's important that we identify that both of those are above this 50 mark. So what does this mean? This report should help alleviate some fears that the U.S. economy was rapidly deteriorating. Recent data with this report included shows an economy that is still expanding, but at a less rapid rate, which is, of course, what we want. We still want our economy to grow, but we need it to slow down a little bit. Last week, we also had initial jobless claims. People filing for unemployment for the first time fell to 233,000. So I emphasize first time, but that's what initial jobless claims is. It's not for the first time that it fell to 2033. It's that people filing for unemployment for the first time fell to 233,000, 17,000 fewer than the week before, below the expected 240,000. The 4-week moving average, however, rose to 240,750, which is the highest reading since 2021. Continuing claims, people continuing to collect unemployment, that is, also rose to the highest level since 2021, coming in at 1,875,000. So last week's, that's the previous week's claims report contributed to stocks pulling back. As investors' fear of recession rose, this week's number appeared to ease those fears, but we again suggest weekly reading can be volatile, especially in the summer, and look at the 4-week moving average. So the 4-week average of these readings, these jobless claims come out every week, and that's one of the things that really torpedoed the market a couple weeks ago. So what our analysts say is, a claims reading above $300,000 is typically when a recession would start to be a possibility, and we remain well below that number at this point. So week ahead, now we've already had 2 days of the week ahead. On Tuesday, I reported that we had the PPI report. Today, we had the CPI report. I gave you those numbers at the beginning. And tomorrow, we have retail sales. Retailers have increasingly noted that segments of the consumer sector are softening. Investors will be looking to see how much slowing is occurring. So we'll see what happens with those reports. Folks, I looked at the analyst reports this week for BlackRock and Goldman Sachs as some of my favorite, and they everybody was really pointing to Fed decision in September. Now people are talking about is the Fed going to cut 0.25% or maybe 0.5%, 0.5% of 1%. So let's see what happens with the Fed in September. And it's been interesting to see, the Vegas odds. What the percentage is, what the probability is that the Fed is going to cut. Now it's very high. I think it's in 85% range. But now, as I said, many people are talking about a higher rate cut, 0.5%. So we'll see what happens. So how do you manage these things? So you've got uncertainty around inflation. You've got uncertainty around the economy. You have uncertainty around interest rates. You have you have uncertainty around elections. So I just want to remind you, when we're talking about investments, we want to build a solid foundation. And that foundation starts with asset allocation, principal protection, and account segmentation. There's a lot of work to do in those 3 pillars, as I refer to them, those 3 pillars of investment management. But you want to build that foundation so that you're going to have some shocks and you're going to have some rumblings if things get terrible or difficult. But it should not crumble your investment plan. And we talked about what to do in a market correction last week. So if you want to go back and review that video, you can. All right, in this section of our weekly webinar, this is our financial focus section, and we're going to talk today about, is life insurance right for your retirement plan? A lot of competing opinions on the internet. Goodness gracious, if you Googled life insurance retirement plan, first of all, you're going to see, I actually think maybe David McKnight coined the phrase a life insurance retirement plan or a LIRP. I don't know. But he wrote a book called Look Before You LIRP. But you're going to see a lot of information, and you're going to see some people who really understand and discuss the benefits of life insurance policies and their use in retirement plans. And you see people who say, run for the hills, don't even think about it. It's a horrible situation. It's only put together to enrich the people who are presenting it to you. And I have opinions about that. I'm going to share my opinions, but the fact of the matter is that it's just like anything else. I'll share this with you as a preamble. Prior to 2012, I was in the camp that life insurance should not be part of a retirement plan. It should be a catastrophic loss kind of situation where you're protecting your heirs for covering a mortgage that needs to be paid off, or college funding that needs to be done, or loss of income or something like that. A light was turned on for me in 2012 when I attended a training event put on by a fellow named Ed Slott. Ed's a CPA out of New York who trains financial advisors and CPAs and attorneys on tax-efficient planning strategies. And I attended a 2-day event in Newark, New Jersey. And after being in the industry for over 10 years and having just achieved my certified financial planner designation, which was a very challenging thing to do, I remember sitting in the back of the room, really smacking my forehead saying, oh my gosh, I've been missing so much for my clients. And the reason is that I had formed biases based on misinformation. So again, these are critical items that you should learn so that you can make the proper decisions for your retirement plan. And one of them certainly is, should you use life insurance in your retirement plan? So let's first, let me share my screen here. So I'm going to share my screen. So I'm sharing my screen here because I'm going to go through some different things that I want to cover today. The first is concept. What is this concept behind funding life insurance, and why may it be right as part of your retirement plan? Now this video is for education. This is not for advice. So if I say anytime in this video, could this be right for your retirement plan? That's a question. You have to explore these things for yourself. And also the tools that we use are very, very important. Some life insurance policies can be very efficient. Some of them can be terribly inefficient. But we're going to talk about concept. We're going to talk about the tax code that addresses the tax efficiency of life insurance. We're going to talk about different options. We're going to talk about pros and cons. We're going to talk about the commitment. And then we're going to talk about structure. Actually, next week, we're going to talk about structure. There are certain things that you want your life insurance policy, if you're going to use it, certain ways you want it to be structured, or certain offerings from your company that you're dealing with to make it an effective plan, in my opinion. So the first thing I want to share with you is my friend and mentor, Ed Slott, who I just told you about, just released his most recent book. And the title of this book is called The Retirement Savings Time Bomb Ticks Louder. So I suggest you go and order this if you have an interest in learning more about your retirement planning strategy. It is no joke. It's 415 pages. There's a lot of material in here. I'm going to focus a little bit on, I'm not going to read this to you, except for one little part. And on chapter 8, and that is the power of life insurance, and specifically this section here. So page 279, read along with me. This reads, to keep your estate plan intact, you'll probably have to replace your IRA. We've already talked about using Roth IRAs as a tax-free alternative, but now it's time to look at what may be an even better idea, the life insurance retirement plan, which means replacing your IRA, a poor estate planning asset, with life insurance, an excellent estate planning asset that is now even more valuable after the Secure Act. Before we continue, you should know that I do not sell life insurance, Ed writes. I do not sell stocks, bonds, funds, or annuities. Never did. I am a CPA and tax planning advisor, and as a tax advisor, I can tell you that the single biggest benefit in the tax code is the income tax exemption for life insurance. You should know about how to use it to reach your goals, especially now that Congress has declared war on your retirement savings. So those are Ed's words. If you're just listening to this on our podcast, Not a Guru podcast, which can be found at any place where you find your podcast. But these are Ed Slott's words in his book, page 279. Ed has been called the nation's IRA expert from the Wall Street Journal. His education and analysts are excellent. I'm fortunate enough to be part of Ed's group. This is one manual from a training event recently. We're required to go to really 2 a year. Anyway, so let's talk about the concept behind what Ed's discussing here with life insurance. Life insurance policies are complex. The concept, though, is very, very simple. When you're talking about permanent insurance, we're talking about permanent insurance, not term insurance. So permanent life insurance and cash value life insurance specifically. Some people refer to these as Ed did, as my friend David McKnight does, life insurance retirement plans. They're interchangeable, cash value life insurance retirement plan. But simply, here's the example. Now, I had this sketched out a different way, but it's just really this simple. Let's just say, for example, you have a $25,000 premium that you're paying for a period of time. It doesn't really matter the period of time. Now, because of the requirements in the tax code, and we're going to talk about those in a second, there has to be a death benefit. The IRS says it can't just be, or the tax code says this can't just be a tax scheme. There has to be a death benefit attached to it. So there has to be a death benefit. So let's just say in this example, you have a $500,000 death benefit. So of course that death benefit goes to your heirs when you're no longer here. And let's say that the $500,000 death benefit costs $2,500 a year. The tax code allows us to put in an additional amount. So it may be, and this is an example, you've got to do some calculations to see what those amounts are. But let's just say that they allow us to put in up to $25,000 a year. The $2,500 goes to the cost of insurance to pay the death benefit. That leaves $22,500 left inside of the insurance policy for investment. Now, there's many different ways, depending on the type of policy that you have, that money can be invested, and we're going to talk about those in a second. But simply, that's the concept. You overfund, you put more money into the life policy than what it costs to fund the death benefit. The amount that you're putting over that amount of the cost of the death benefit is in the policy, and it grows. Why do you want it to grow inside of the life insurance instead of inside of your brokerage account, for example? Well, your brokerage account is always going to be taxed. Capital gains tax, interest, dividends. Sometimes you can't manage those capital gains because you're invested in a mutual fund. Once that $22,500 goes into the life insurance policy, it's not taxed again as long as you follow the rules. So it grows tax deferred, comes out tax free. It's protecting, you're putting a wrapper around that money so it'll never be taxed again. So I hope that simplifies things because the concept is really that simple. Now, the application, of course, is much more complex. There is no doubt that life insurance policies are complex. There are many moving parts. There are many tax requirements. There are many costs involved. But I don't think a person should shy away from a good planning tool just because they're complex. Folks, ETFs, exchange traded funds, are very, very popular. They are complex instruments. Mutual funds are complex instruments. There are many complex instruments that are beneficial. So that is the concept. Let's talk about the tax code. So the tax code is section 7702. And I went to I looked for some, and here it is. So I got a copy of it here. So if you want, you can Google it. And there's a lot of, this is about eight or nine pages, and you can read through all this, right? But I went to, and I found Investopedia. I like Investopedia. Just for common kind of everyday explanation of things. And let's just read this together. So this section 7702 is the section that covers life insurance and allows for this favored tax treatment in life insurance policies, but with conditions. So there are conditions that have to be met. That's why these things have to be properly structured. So what is Section 7702? Again, this is from Investopedia. Section 7702 of the U.S. Internal Revenue Service Tax Code defines what the federal government considers to be a legitimate life insurance contract and is used to determine how the proceeds of the policy generates are taxed. The proceeds of policies that do not meet the government's definition are taxable as ordinary income. So you got to be careful how these are structured and managed. Proceeds from genuine life insurance contracts are tax advantaged. Section 7702 applies only to life insurance contracts issued after the year 1984. So they listed some key takeaways that I thought were good. Section 7702 of the tax code differentiates between income from a genuine insurance product and income from an investment vehicle. Certain types of permanent life insurance build up a cash value over time. The proceeds of a true life insurance contract receive favorable tax treatment. The proceeds of a contract that does not meet the IRS definition are taxed as ordinary income. An insurance policy that fails Section 7702 criteria becomes a modified endowment contract and permanently loses its tax advantage status. So that is the tax code, Section 7702. And again, it is really, really easy to find that information. You can go to the IRS website. If you're a very technical person and you want to read this tax code, I suggest you do. If you have questions, also, I mentioned David McKnight's book. I'm going to write it here. Look Before You Lerp. I suggest you're reading that book. I'm going to talk about some of the things in that book next week. But that's a very, very good book. If you're a client of ours and you don't have a copy of that book and you want a copy, I'll send you a copy if you're a client of ours. Otherwise, go to Amazon and order yourself a copy. But that's the IRS code that covers the use of life insurance policies. So now let's talk about options. So we're not talking about term insurance. We're talking about cash value life insurance. So for life insurance to have it, you were talking about building up cash value. There are a few different options. So you all know about whole life, right? Whole life. So a whole life policy simply says you're going to invest the money, like I just talked about, go back to that $22,500 that you have left, and you're investing that with a specific company. I'm not going to mention any specific companies because I don't want you to take this as advice to go work with those companies. But a whole life company will issue a dividend, and you receive a portion of that dividend. So if their stated dividend is 5%, you're not going to really receive the 5%. You'll receive maybe 4.89, something like. You'll receive a portion of that dividend. So every year, the dividend is applied into your bucket that you have, where your extra money that isn't going to pay for the life insurance, death benefit, I should say. So the extra money that isn't going to pay for the death benefit, it stays in that bucket, and then you get a dividend applied to that. So if it's 4.89%, you're $22,500. They add 4.89% to that, and it grows like that. So that's whole life. Very, very simple. There is, when you're talking about cash value of life insurance, there is also variable universal life. Now, variable universal life has what are called sub-accounts. So sub-accounts are mutual funds that are within the life insurance policy. The life insurance policy will allow you to choose all different sub-accounts. You can build up really a robust portfolio, and you could have growth, and you could also have loss. So you could have you're going to invest in these mutual funds. They could grow, or they could lose value. So could grow, could lose value. The whole life only has that dividend, no risk of loss. Variable universal life just by market growth. Now, if a life insurance company cuts their dividends and their expenses are greater than the dividend amount, then your cash value could go down. Variable universal life, your cash value could go down because of the cost of the contract. It could also go down because of market activity. So if your funds are down 30%, and then you've got 5% of fees on top of that 30%, well, then you're sucking down 35% in that year with a variable universal life policy. Another popular option is an index universal life, IUL. So an index universal life policy allows you to invest in an index within the life insurance policy and have a performance tied to that index. You actually don't invest in the index. You get credited interest tied to the performance of an index. That index can increase in value, but index universal life policies have a floor of at least 0. So the worst you're going to do in any given year is a 0% return on your investment. Now, again, if you have a 0% return, if you have a 5% fee, and I'm using 5% as an example, not, life insurance policies have all different fees depending on the company. So if in fact you have a 0% return and you have, for example, a 5% charge in your life insurance policy, then in fact you'll lose 5%. But you can have growth in these also depending on the return of the index. So it could be the S&P 500. It could be a manufactured index put on by Bloomberg or BlackRock. And again, it is very complicated. We want anything. Variable universal life is a little different because you can have really varying returns. When we're talking about whole life and index universal life, we want to shoot for about 4 to 6%. That's a good goal. So if we're averaging 4 to 6% a year, it has a good opportunity to be working for you, potentially. Variable universal life, I will tell you, I am not a fan of variable universal life because of the risk involved. When you lay over the cost of insurance, particularly in the early years with potential market risk, it's not something that I want to put my clients into. But you take that for what it's worth. So pros and cons. So I talked about the con of the variable universal life. The pros, of course, are you can have outstanding performance. The cons of the whole life is that your company, you're really at the mercy of what the company declares as dividends. So you want to look for a company that has steady dividends for a long period of time. Many of these companies have over 100 years of dividends now, with interest rates the way they have been over the past decade or more, except for recent years. Those dividends have come down, but you have to take that into account. And then also the stability of the company. The pros of a whole life policy is really consistency, right? You're going to probably have some more potentially consistent returns. The pros of an index universal life policy are that you have some greater potential for return than you have with a whole life policy, and you have a floor of at least 0. The worst year you're going to have is 0. So you've got a band of acceptable returns. So 0 to, let's use this example, 4 to 6%. That's kind of the band of returns that you're looking for. The cons of index universal life policies, again, complexity. You're tied to index returns that can be capped, can be complex. There are costs associated with all of them. So these are some of the cons associated with the use of life insurance in your retirement plan. And then, of course, there's commitment, folks. Commitment. Now, that could be a pro or a con, depending on how you feel about it. But it is likely that whatever life insurance policy you choose, you're going to have for the rest of your life. Yes, there are opportunities where you can exchange them along the way if something's better, but most people have that. When you're talking about cash value life insurance or permanent life insurance, you're going to have that for the rest of your life. You're committing those funds, and you should manage those investments as often as possible every year, or even with a variable universal life, it can be more frequently. But you are going to be committed. That's why David wrote "Look before you lerp" and referred to it as a marriage, right? He has two kind of wedding rings on there because you're married. You know, the insurance company is committing to you for the rest of your life, and really you're committing to this strategy for the rest of your life as well. So that commitment is very, very important. And I wrote next year I'm going to do this for structure. Folks, we're not going to wait that long. It's going to be next week. We're going to talk about the structure and how these policies should be structured to be give you the best chance at effectiveness. So let's talk though. So now that you understand a little bit more about the cash value life insurance or life insurance retirement plans, let's talk about if they can be right for your plan. So here's where they could fit in potentially to a plan. So we know our buckets here. You've got your taxable bucket, tax deferred, and tax advantage bucket. And there's really only two things that fit into this tax advantage bucket: Roth IRAs and qualified cash value of life insurance policies or life insurance retirement plans. So you want an ideal amount to be in each one of these buckets. We know in your taxable buckets, that's 6 months to 1 year of expenses. Anything above that is going to generate tax for the rest of your life. It's going to generate capital gains tax, interest, short-term capital gains, long-term capital gains. It's just forever taxed, as Ed Slott says. Tax deferred are your IRA accounts. So we know the problem with the IRA accounts that if taxes are likely to be higher in the future, then when you have to start drawing out your money for your IRAs, whether they're required via required minimum distributions, or if it's just for distributions that you need for your lifetime, well, geez, you might be paying more in tax than you're anticipating. And that can be really troublesome and greatly hinder your ability to have a successful retirement. But there are things that we can do to transfer money from the tax deferred bucket into the tax advantage bucket by using Roth, right? We can do Roth conversions. That's simple. It's not easy, but the concept, again, is simple. There's a lot of calculations involved in appropriately converting Roth IRAs. It depends on your needs for what schedule that is, what tax you're going to pay on those conversions. So if you have a significant amount of money, as most Americans do, in this tax deferred bucket, well, heck, you can convert those funds to a Roth IRA either immediately or over time, whatever works best for you. There are no speed limits set by the IRS on that, or the tax code on that, and I have lots of videos talking about Roth IRAs, and we'll see if we can find a good one and include it in this description. The problem arises for a lot of people when you have a lot of money or more money than you need, more money than that 6 months or 1 year in this taxable bucket, because for most people you can't put this taxable money into a Roth. Can't go, okay, let me put that into a Roth. Now, with some exceptions, you can do some contributions. They're relatively small, and they have income requirements. So that may or may not work for you. And for most people, it doesn't allow the taxable account to stop growing and start shifting to a tax-advantaged bucket that you can use later in life. So this is where using the cash value of life insurance may work for you if it's appropriate. Is it right for your plan? So in our example of using $25,000 a year, and it really doesn't matter for this example how long you're funding it. Let's just say it's over 10 years, times 10 years. And you put that in there, and let's just say that gets you a $500,000 death benefit, as we talked about. Well, remember, $2,500 is, or I'm sorry, $2,500 in our example is going to pay for that death benefit, and $22,500 is staying protected, tax protected in this bucket, and can build over time. So you have those various investment options I talked about: whole life, variable universal life, index universal life. Really doesn't matter for these purposes. This $25,000 goes in here. $2,500 goes to the life insurance company to pay for your death benefit, and that remaining $22,500 builds every year till you build up a cash value. Now, Section 7702 says if you do this properly, you're going to have a cash value. Let's say you have a $300,000 cash value by the time you're building this all up. Now you can take distributions out of your life insurance policy if you want to, and as long as you follow the rules, any distribution that comes out of here is 0% tax. And they're structured as a loan. There's a lot of provisions around that, but it can work very well where folks start taking annual distributions or more lump sum distributions, and they don't pay tax on that money. Of course, any death benefit that's passed to your heirs is also 0% tax. And many policies today also have a long-term care provision that's tied to the death benefit that allows you to use your death benefit prior to your death for long-term care expenses if you meet certain requirements. And those requirements typically are you can't do 2 out of 6 activities of daily living. And of course, any long-term care needs that are paid out also come out zero tax-free. So you have to ask yourself if it's right for your retirement plan to, instead of building money that's going to be forever taxed and cause yourself and potentially your heirs a huge tax bill or a higher tax bill, what if you take a portion of that and you redirect it into a life insurance policy that now is protected, as long as you follow the rules, now is protected against tax? Of course, if you have stocks, bonds, mutual funds, you're going to have to pay capital gains tax to liquidate those positions and move them into here, the life insurance. But just like converting your traditional IRA to a Roth IRA, it's depending on your situation, it may be better to pay the tax at the rates we have today compared to the rates that we're going to have in 10 years. That applies to ordinary income tax when you're converting a traditional IRA to a Roth IRA, just as it applies to capital gains tax. Capital gains tax, actually, in my opinion, is going to be one of the first bullseyes that we're going to see. We're going to see an increase. We already had a proposed increase that came out of the White House that wanted to increase the highest capital gains from 23.8% to 44.6%. So I don't think that proposal is going anywhere for now, but that's the discussion that's going on in Washington. So is this process right for you? It all depends. First of all, do you have a significant amount of money in your taxable bucket that you want to move over and have it protected against future tax? Some people even take money out of their IRA and move it to cash value life insurance instead of moving it to Roth. Maybe there's a significant amount that they've already moved to Roth and they have different purposes that they want to use the life insurance for. That's okay too. But there are some requirements. Anybody can do a Roth IRA. If you have money in a traditional IRA, you can establish a Roth IRA and convert that money. That's easy. Again, that's simple. It's not necessarily easy. But not everybody, folks, can do a life insurance contract. It depends on your health. More so your health than your age, I've found. There's a certain age, over 75, I don't think there's an option for you. But even if you're in your 70s and you're healthy, you may be able to find a decent policy. But if your health is not good, or if you're not insurable, it doesn't work for you. So why, if your health isn't good and you are insurable, may it not work for you? Because the cost might be too high. Remember the example I used where in this case, you put $25,000 in, $2,500 went to the cost of insurance. Well, what if your health is not good and the life insurance company says, well, hey, we're going to issue you a policy, but we're going to make you pay for it because there's a lot of risk. And suddenly you're paying $10,000 a year into that or more. Then it may not make sense. Too much of your money is going out to the insurance company and not staying in here for you. We want the money here, your money. Your money. We want it to stay here, not insurance money. So if you're listening just on the podcast, again, I'm drawing on a whiteboard. You might want to go to the YouTube channel just so you can see what the heck I'm talking about. But so to answer the question, is life insurance right for your retirement plan? Well, folks, you got to educate yourself. So I talked about, one of the most respected tax experts in the nation, what his thoughts are about life insurance. I showed you the tax code. We talked about the different options. We talked about concept. This is certainly a commitment, so you want to understand and you want to feel comfortable with the platform you're getting into. And we talked about what's coming up next week. We're going to talk about the structure, what we want to pay attention to. If life insurance is right for you, what should we be paying attention to? And then I gave you a little sketch plan here of generally how that funding could work. But again, it's all individualized. It may be right for you, it may not be right for you, but I hope now that you've got some education basis to make that decision. Folks, that's it for this week. And with that, everybody, have a good rest of your week. We'll see you next week. I hope this was helpful. Take care.